Welcome back to AI Research. Today we are diving deep into the heartbeat of the global economy, the federal funds effective rate. By looking at the long-term charts and the most recent data as of early 2026, we can decode where the smart money is moving. Current market analysis, January 2026. As we look at the latest data from the St. Louis Fed, FRED, the current federal funds effective rate sits at approximately 3.72% as of December 2025. We are currently witnessing a plateau and descent pattern. After the aggressive hiking cycle of 2022-2023, which saw rates peak above 5.3%, the Fed has spent much of 2025 cutting rates. This signals that the central bank believes inflation is cooling and is shifting its focus toward protecting the labor market. Learning from the past, peaks and valleys. To understand where we are going, we have to look at the extremes of the chart. The Fed uses interest rates as both a brake and a gas pedal, based on their dual mandate: price stability and maximum employment. The peaks, the war on inflation. The 1980s record, 20%, under Chair Paul Volcker, the Fed pushed rates to their highest level in history to break stagflation. This was a painful but necessary reset for the U.S. economy. The 2023 peak, 5.3%, this was the sharpest hiking cycle in 40 years, aimed at neutralizing the post-pandemic inflation surge. The valleys, emergency life support. The Great Recession, 2008 to 2015, for 7 years, the Fed kept rates at 0%. This easy money era fueled a massive rally in tech stocks and real estate but left the Fed with few tools when the next crisis hit. The COVID-19 pandemic, 2020, rates were slashed to zero almost overnight to prevent a total financial freeze-up during global lockdowns. Investor insights: what this means for you. As we move through 2026 with a rate of 3.72%, here is how you should position your portfolio. Fixed income. If you are holding short-term CDs or money market funds, your yields are dropping. It may be time to lock in longer-term yields in the bond market before the Fed cuts further. Equity markets. Lower rates generally mean a lower cost of capital. This is bullish for growth sectors like technology and AI, as future earnings are now discounted at a lower rate, making valuations more attractive. Real estate. We are seeing a gradual easing in mortgage rates. This correlation often triggers a thaw in the housing market as borrowing becomes more affordable for the average consumer. The neutral target. The market is currently betting on a soft landing. If the Fed stabilizes rates around 3 to 3.5%, it suggests a healthy economy that isn't overheating but isn't in a tailspin either. The next major update is scheduled for the FOMC release on January 6, 2026. We will be watching closely to see if they signal a pause or a continuation of this downward trend. Alright, this is the AI Research. If you find any value in this, subscribe for more. See you in the next video.